corporate issuers. So previously we saw how to do credit analysis for sovereign issues, such as those issued by a government or a government agency or a state which is part of a country. Now we're going to look at how to do this for a corporation, how to assess their credit worthiness, right? And how do we use ratios in that process? And if a corporation has multiple layers of debt, so what are the rankings? Which debt gets paid back first, right? Is there an impact of recovery rates? And do they have different credit ratings? So what you'll see over here is that there is going to be a corporate family rating, and then the separate bonds might have different ratings, right? So you might have senior, you might have junior bonds, you might have senior bonds, and so let's say the corporate family rating is A, so the senior bonds might be a notch up and the junior bonds might be a notch down. So it could be something like that. So let's get into it, starting with what we're going to talk about in this entire reading, which is qualitative and quantitative factors in assessing and evaluating the credit worthiness of a corporate borrower, then using financial ratios in this type of credit analysis, and then finally getting into the rankings of the debt and how it impacts the different credit ratings. So, how do you go about assessing the corporate credit worthiness? What is credit worthiness? So, of course, there is assets in every company, right? There is a liability and then there is equity. And what we want to see is whatever liabilities that they have, such as bank loans, right? Bonds. So whatever these liabilities are they having enough assets or enough ability to generate profits and cash based on those assets to be able to not only pay back the principal but also meet the interest requirement on these liabilities, right? Equity, of course, will be paid after the liabilities have been settled. So liabilities are senior than equity, but within liabilities you have different levels of seniority. So that is what we're going to look at. But before we get into the different layers of the liabilities and how you go about ranking them and then how does that affect their credit rating, let us have a look at the high level analysis of the entire corporation, that how safe is its business. Now, before I get into the discussion about business risk, I want to talk a little bit about corporate governance. And what I really want to talk about is Enron. So Enron was a very, very big company. Most of you won't remember it or were not born or were very young when the Enron scandal happened. So this was in the 2000. And if you want to watch a movie about it, it's called The Smartest Guys in the Room, right? And what happened with Enron was that up until the Enron scandal, companies were primarily considered to be institutions that are there to generate profits for shareholders. That is their primary motive. And that was the shareholder theory, right? But then you have the stakeholder theory. Which says that, hey, shareholders are not the only stakeholder, right? There are other stakeholders in a business, such as the providers of debt, right? So to be able to see a company's ability to satisfy its debt obligations, the first thing we want to see is that do they even realize that there is another big stakeholder in the corporation, and it's not your shareholders, it's your debt holders. Of course, there are other stakeholders as well, such as the management and the employees and the customers and the suppliers and the government, which gets tax, and the society, which gets benefits. But apart from the shareholder, the biggest stake that might be there in terms of the providers of capital is, of course, your debt providers, right? So we want to see good corporate governance to start with, that the board of directors is not consisting of only shareholders and senior management of the company. It also has independent directors who will be unbiased and will try to protect the interest of the debt holders, right? Because if it was only shareholders and only management, then they probably would increase the risk to a very high level, because they might want higher profits and the management want higher bonuses. But the debt holder don't share in the profit. The debt holders get a fixed rate of interest. So the higher risk doesn't benefit the debt holders. They would like a lower level of risk and a safe business, because what they want is their interest and principal back on time, right? So there is a conflict between the equity holders and the debt holders, and therefore corporate governance needs to be there. Independent directors need to be there in the board of directors to ensure that the interest of the debt holders is protected. Right. Now, once that is there, we can talk about other things such as the business model and the industry and competition. Now, when I talk about the business model, what we are really interested in stability and predictability, right? That it should be a very stable and predictable business where the sales, revenue, and the margin that is being generated from that revenue is stable. Now, that ties in with your industry concentration or the number of competitors, because if we are having too much competition, then it's very difficult to hold on to your margin, because as more and more suppliers and firms come into an industry, they tend to lower the price and erode the margin. So what happens is competitive forces lead to erosion of margins, and we don't like that. So what we want is less competition, more concentration, so which gives more pricing power. So even if cost goes up because of inflation, you are able to increase your prices and maintain your margin, right? Because that is what we like to see, that stable revenue and stable margin is there. And that will only be coming if the business model is nice, right? And the industry and competition is not that competitive, it is relatively concentrated, and thereby a company will be able to maintain its sales, even grow it, and maintain its margin. So that is your business risk, right? Now we can break up business risk into external factors, industry specific, and issuer specific. So for the highest level is the external factors, right, where we are saying what's happening in the economy, the macroeconomic perspective, that okay, if you're investing in, let's say, Vietnam, right, or let's say if you're investing in a company called Samsung and it's based out of South Korea, right? So first you want to see, before you buy bonds issued by Samsung, what you want to see first is that how's South Korea doing as a country, right? Macroeconomically, demographically, geopolitics, other factors. Then what you want to see is that, okay, how are smartphones doing as an industry, right? How are TVs and whatever other products Samsung makes, how are those industries doing? And then, of course, we can get into the specific matters regarding the company itself, what we call idiosyncratic. So, idiosyncratic or issuer specific factors, that what's going on with that company. So, this is all going to come together, all three of these come together to make your business risk. Let's get into a bit more detail about all of this. So naturally, what we like is stable and predictable business, right? So the business risk is low, cash flows are stable, less competitive pressures, and they will have the ability to use higher debt. And one of my particular favorites will be utility companies. Usually what we see is that they have monopolies, right? I mean, think about your local electricity supplier. There's probably going to be just one, right, in your local city or town or neighborhood. They usually are monopolies, so very less competition, very very stable business, right? Even when the COVID lockdown was there, people were still using electricity, right? So these type of companies can afford to use a high amount of debt in their capital structure, and there is a very low chance of default because they have a very safe, stable business model. Now, compared to that, companies which are very volatile, they have higher amount of business risk, lot of competition, greater amount of competition. Naturally, for them, use of debt should be low, right? And maybe they should use more equity in their capital structure. And usually, what we also see is in terms of the industry life cycle and the company life cycle, that it's not just smaller firms, but it's also newer firms that have just started up, right? And they have less stable cash flows. As firms become more mature, their cash flows become more stable and predictable. So, as firms mature, the use of debt can increase. Now, what type of analysis is done by analysts that are looking for undervalued stocks or overvalued stocks to short sell, and how is that different from analysts that are looking for bonds to invest in? So, stocks or equity doesn't have an expiration date, right? Common equity is forever, it's infinity. There is no expiration date on it. And therefore, what an equity analyst will be doing is focusing on the future cash flows, that what is the lifetime potential of this company. Because even if they are having a shorter holding period, the person who they will sell the equity to might have a much longer holding period, or their eventual buyer will have a longer holding period. So since the stock or the equity doesn't have an expiration date, so what we do is we look at a long term perspective here. We take a terminal value, and if you've already covered your equity material, you know that that comes from D1 divided by R minus G, which gives you V0, right? And if, let's say, you think that it will reach that stable growth rate 10 years from now, so you will take the D10 and it will give you the V9, then you can bring that back to today. But the point is that we take a assumption over here that this company will grow at this sustainable growth rate forever. Now with fixed income, it is completely different. We're looking at a much shorter time frame, right? We want to see, will we be able to get our principal and interest back in a certain number of years, whatever is the maturity of that particular instrument, right? And then even within that, we have different types of bonds or instruments or loans. Some might be secured, whereas some might be unsecured. Now, what does that mean? Well, secured ones have some kind of collateral, right? Ideally, tangible collateral such as a real estate or some factory equipment or some receivables, which is still hard cash, right? I mean, it's not cash, but it is as good as a monetary asset because it can be converted to cash if they are good quality receivables. Or you could have something which is completely intangible, which is not preferred, but it could be there, such as maybe a patent or a copyright or a trademark, right, which has a certain value. But in case of your unsecured debt, It's just the company's cash flows. And why this is really important is because at the beginning of this video, what I talked about is something called a corporate family rating, right? And this is something I want to keep re-emphasizing throughout this learning module, is that there will be a rating given to the entire corporate family, which is the company. And then let's say this corporation has some secured bonds and some unsecured bonds. So the unsecured bonds are basically having that corporation as their source, their primary source of repayment. So the rating, let's say for the corporation, let's say is A, and that is the rating that should be there for the unsecured bonds, if not lower, right? Because the unsecured bonds have the corporation to fall back on. Now, the secured bonds might have a rating a notch higher. Why? Because there might be some asset that is there dedicated for the payment of these secured bonds. So that is actually safer than depending on the corporate family. And I'll talk about it a little more shortly, but this is a concept that I want to build throughout this learning module, right? Now, of course, the rate that this company will pay will be lower on the secured debt, so they might be paying 5% on the secured debt and maybe 7% on the unsecured debt. So the secured debt can definitely reduce the cost of borrowing. So as a company, if you have some assets that you can give as collateral, then you can issue secured debt, which means the cost of borrowing goes down. But unfortunately, if you don't have those assets, then what you have to do is go for unsecured. But that is still going to be better than going for equity, right? Because if you sell shares, then you're sharing your profits. You're giving somebody part of your company. Maybe they will come and sit on the board and start voting on matters in a way that you might not like. So secured is the cheapest, but if you don't have assets for that, then you can go for unsecured borrowing. And if you can't do that, then of course equity is what you can issue, which means you will be sharing the ownership of your company and you will have to share the profits and the decision making as well. Corporate governance is of course a very, very important factor, right? I mean, it's like dealing with people, right? I mean, if somebody is really smart but they don't have integrity, I mean, what good is their smartness? So just like that with companies also, I mean, just because they have a very high ability to repay, but the willingness is not there, right? So then what's the point of lending to them? So what number one thing we want to see is that are they really meaning well, and they are considering not only the shareholders as the only stakeholder, but also they realize that debt holders have a large stake in the business and they should be able to protect their interest by putting on restrictions onto the company, onto the borrower, which is the company, that how they use the money, the debt proceeds that have been given to them, right? They shouldn't use it to pay huge dividends to the shareholders. They should use it to do some stable business and then use cash flows from that business to pay the interest and principal on time. Fixed income analysts should also be very, very carefully monitoring aggressive accounting policies, right? And again, off balance sheet financing, very relevant for the Enron scandal. And then we also have now the IFRS 16, which stops this type of activity because now leases are required to be brought onto the balance sheet. You cannot have off balance sheet, right? You need to book that right of use of an asset and you need to book that lease liability as we discussed in FSA, in financial statement analysis, right? And we also discussed in FSA that what are the rules for capitalizing certain costs and expensing certain costs, and if a company is aggressively capitalizing them instead of expensing them, that is definitely a potential red flag, right? Also in FSA we talked about revenue recognition rules, and because this is a principle based standard, so there is some subjectivity involved over here. And therefore, companies could be doing aggressive revenue recognition. As an analyst, we need to keep an eye out for that. Right, let's take a break here and then we'll come back and talk about the quantitative factors. So far, we have been talking about qualitative factors, and then next, we're going to talk about quantitative factors in assessing a company's credit risk.